Swayam Prabha. Digital India. Educated India.
Welcome friends once again to this course on international trade theories and empirics. We are on the 41st lecture on the understanding of trade and balance of payment. In our previous lectures, entire 40 lectures in a nutshell, if I simply speak, that what it contains strategies of international trade. So, the latter part of the course largely talks about protection, the strategic protection considered by the individual member countries under WTO. Now, beyond strategic protection and the international theories, we have some other financial aspects for understanding trade and development. It is titled as trade and balance of payment. I think balance of payment is not uncommon. We understand from various perspectives. First of all, when we unfold the discussion of balance of payment, we wanted to understand what are the different types of balance of payment and what are the different heads under it and what it covers, why it is called balance of payment. Largely, we will stick to this portion in this particular week. In the next two lectures, we will be sticking to this part, and after that 2 lectures we will be trying to understand the foreign exchange market. And balance of payment has been becoming interesting topic for India and other developing countries, especially in the present phase of crisis which has been unfolded in 2019. That is on due to the onset of COVID-19. So, in the COVID-19, the paradigm has been shifting from one direction to another direction, and that why is it the case? Because the country which used to be dependent on other countries, they are now reluctant to take many of their imports for their dependence. So, since the imports content is declining steadily, that has impacted the equation, the payment structure for the balance of payment accounting, and we are going to discuss the latest newspaper and their aspects. Now, I am just showing it at this moment that there are some in balance payment considers positive aspects as well as negative entries. Plus are generally the side called entered in the head of current account, capital account and financial account. 3 heads are there. So, in balance of payment, as I said, plus means I refer to credit aspect, and the minus means it is of debited side. So, the debit and credit side, when those are balances each other, it is roughly said balance of payment. But as you know that though in accounting sense we used to refer to as debit and credit to be balanced, that is the reason why we define the term as balance of payment. But actually in reality there are discrepancies between the credit side and the debit side. So the debit sides are considered to be as some kind of official reserve transactions we are going to discuss. And the next part of our discussion after 2 lectures from 43rd lecture onwards will be restricting ourselves to the foreign exchange market. But these first 2 lectures are based on this left hand side of the portion. So, the right hand side aspect we will discuss in the respective lecture hour. Now, let us understand what is going on around us, what are the latest evidences we must understand that the COVID-19 crisis actually led to a current account surplus this year, especially we are referring to India's current account deficit. CAD stands for current accounts deficit, and that CAD, famously known as CAD for current account deficit, this is in surplus. Published in the very recent newspaper that is called The Hindu Business Line on May 21st, 2020. You can also click on this link. This will be redirecting you to open the respective page, and you can read other details of that newspaper. I simply wanted to mention that the author addressed or postulates a possible positive aspects of the India's balance of payment, and the author identified or mentions very clearly that India's imports is going to be collapsing more than it exports, because India used to be the dependent country on many developed countries in terms of imports. Especially the re-exporting section is also very badly hit. Now, Barclays, even the newspaper cited Barclays forecast on this particular direction that India would report a current account surplus of 19.6 US billion dollar or 0.7% of that GDP in the financial year 2021. Now, there will be a positive growth in the current account balance. We are referring to current account balance, we are referring to, we will clarify what you mean by current account, basically export and import of merchandise, goods and services. Okay. So, the financial aspects are not discussed, not included in this accounting. So, since our imports are going to be badly hit in this time, in this critical time, because of less or shrinking in the aggregate demand for imports, people are squeezed with our net aggregate demand, and that has been the matter of discussion over last so many months. Government is trying to give bailout packages, many important investment to increase the aggregate demand, but still the aggregate demand is not popping off at a faster rate to recover the economy. And so, Barclay forecasted accordingly that it will certainly affect the net imports, and so hence the current account section will reflect a surplus for sure. And I think that has already been estimated, and India has already experienced a surplus. Now, coming to the COVID crisis, once again the CAD surplus this year as also pointed out by our Minister of Commerce and Industries, Sri Piyush Goyal, that he stated in the press conference that this is going to be, the year is going to be very strong, and that will be visible in an economy. And so, let us come to the exact countdown where the country is actually going to encase its benefits, and where country may tap, and how to tap it, what are the direction to it. We will explain everything one by one. Now, coming to while India's import bill is quite likely to bounce back once the COVID impact subsides, the pandemic appears to be permanently reordering India's BOP dynamics in three important ways. Okay. So, the dynamics, the pandemic heated the economy, and in most three important ways. First one is India's merchandise exports have always been hypersensitive to demand and growth in destination market. Now, what are the explanation to this hypersensitive demand to the merchandise exports is explained by WTO's forecast that global trade could shrink by a third in 2020, okay, 1/3 shrink of global trade, as well as a rising protectionism policies adopted by the member countries like US could pose further challenges to a quick revival in merchandise exports, particularly for discretionary items like jewelry and apparels. Now, I think from the beginning of the lecture, even in the mid of the sections or around 30-35 lectures, I have particularly mentioned that India takes benefits in re-exporting after taking the raw crude metals from the Middle East countries. Now, I think the relationship of India's with those Middle East countries to a large extent has been disturbed due to some political interplay in between. So, this sector is expected to be badly hit. Apart from getting battered, our MSME sector largely they are informal type or operating at a small scale. The number of policies that are designed so far has not been catering to the need of the MSMEs. So, there occurs a critical cox in the export supply chain for them, because the market is not well functioning for their outputs. And so, they will be back on their feet in short order. Diversifying India's export basket may now be essential for export revival. Coming to the second most important point identified the author, suggested by the author, that India's service sector exports, usually driven by IT and ITES enabled services, have traditionally with the crisis by leveraging their labor cost advantage to grab a bigger share for the global offshoring pie. But this time around curbs on global travel and rising barriers of protectionism threaten the offshoring model itself in this particular segment also. Coming to the third important point that is relevant, where India is going to suffer, as mentioned, that there will be inward remittances from NRIs, particularly in West Asia, have been a key safety net on India's BOP position during past crises. As I mentioned, the West Asia is a matter of concern for India and its connection with BOP. But with West Asian economies laid down by the oil route, this time around India may have to brace for not just a sharp fall in remittances, but also a reverse migration of its diaspora. So, that is also a matter of concern. So, what India actually need? India needs to focus on ensuring that foreign direct and portfolio investors continue to find it attractive destination once the dust settles on cloud. So, first suggested by the author is on in more investment or facilitation for foreign direct investment and portfolio investment. Second one is stimulus packages. So far has been very limited in the Indian market. Now, after saying this direction and unfolding the scenario presently going on, which may continue for even another couple of years, and if you read the past history, the 100 years back pandemic that is unearthed in the world economy due to Spanish flu in 1999, that has actually created massive disturbances, massive entropy in the world, and the BOP is very badly hit. The country's stability, macroeconomic structure gets hit very badly or adversely. That is the reason why we are very interested to study the components of BOP and where in which direction BOP stands. So, our interest is here to define BOP correctly. So, BOP's balance of payment is a systematic record of the statement made by the member countries for their transactions within a specific period of time. Usually, the specific period of time is defined as 1 year. So, it is the record of the reporting country and the exporting country for all their transaction within 1 year. Okay. So, that is why it is called summary statement of international transaction for a country for a specific period of time. An international transaction is actually the exchange of a good, a service or asset between residents of one nation and resident of another nation, which I have already mentioned. The main purpose of the balance of payment is to help the government in formulation of monetary, fiscal and trade related policies. Coming to the components of it, balance of payment is usually based on double accounting bookkeeping procedure, double entry bookkeeping procedure. So, basically whatever being transacted, it is entered as in the credit side as well as in the debit side. So, it follows a double entry bookkeeping pattern. For example, anything is exchanged. So, there is a contract involved. The contract is entered to be as a return in the credit side, and so when the transfer is made at that moment, it is entered as a debit side. Now coming to the principles of payments, as I already mentioned, it follows double entry bookkeeping. I can write it down. Probably that point has been missed in the slide. Double entry bookkeeping. You can take a note. Double entry bookkeeping is the procedure mandatorily followed in the accounting principles of BOP. So, there is a credit side called plus transaction, and debit side is called negative transaction. Transaction that involve receipt of payments is called credit, like export of goods and services. So, why it is on the credit side? Because of its returns of a contract. Okay, by exporting to another country, we get in return the capital or return in terms of commodities. Now, similarly, there are unilateral transfer like gifts from foreigners. So, that also helps the member countries to get equivalent amount as a positive side. Another direction of this is through financial flows. That may be due to increase in foreign assets in a nation, reduction in a nation's assets abroad. So, increase in foreign assets in a country, like the country invests in another country, its own FDI in another country. So, its assets increases, the profit earned due to that also gets credited as an entry to the country's balance of payment. Similarly, reduction in the nation's assets abroad. Okay. So, nation's asset abroad and foreign assets within a nation, like foreign assets within the nation that we get for FDI within the country. So, more the FDI within the country, more financial investment we have, more return if derived, that is entered as positive. Whereas, the reverse, like we invest elsewhere, but the return entered largely to that country only, that is called negative side. So, that is why when we reduce our asset elsewhere, then that will be better. Coming to the debit side of the transaction, it involves like transaction involve payment to foreign parties or foreign sources. So, for example, if in the reverse direction called imports of goods are there, we are bound to return in some forms, that is the reason why these are entered as negative side. Similarly, gifts to the foreigners and increase in nation's assets abroad or of reduction in foreign investment in our country is also a part of negative side of the transaction. So, in balance of payment accounting, each international transaction is recorded twice, once as credit and once as debit. Okay. So, for example, here $500 exports to be paid in 3 months time. Suppose that is the case, how to enter it, how that is enter, like goods exported first equivalent to $500 US. So, that is entered as 500 as positive, because since we are exporting the value, we have a contract clause with a binding clause to get it with interest or with the same amount of 500. That, so, that is the reason why it is entered as entered in the credit side. Similarly, since there are debit flows involved, financial flows involved, First of all, a credit side involved. Since certain amount we are exporting in terms of goods and its value, so there is a debit side also involved. So, since debit and credit both sides are involved and these are entered together, that is the reason why balance of payment is defined to be in balance. Similarly, each international transaction is recorded twice, as we already said. In another example, like $200 spent by an Indian tourist in London, okay, for maybe for hotel services, for restaurant services, okay, $200 Indian tourist spent in London. What really happens here, that the person might have taken travel services, purchase from foreigners for travel, like taxi or maybe boating, any other kind. So, the travel services since accessed by the Indians, so there will be a debit side very quickly. We purchase, we have to pay that amount. Now, since that had been debited, now again because of that it might have that amount is also entered in the financial inflows entry, because the amount which we have spent has another entry, that is the amount of possible amount of inflows is recorded from the foreigners. Okay. So, 200 is also entering the positive side. Now, similarly, if $100 in Indian government foreign aid given by given to the government of another to the government of another nation, Indian government foreign aid given to the government of another nation. So, in that case what it is related to unilateral transfer. So, even if it is unilateral transfer, so entered initially as debit, because Indian government has paid. So, with the expectation that 100 financial inflows is due to come. So, 100 is also entered in the financial inflows. Okay. Similarly, $400 in foreign stock purchased by Indian resident, foreign shares and stock market shares. If the foreign Indian purchase from foreign stock market, then since we purchased, we first paid. Okay. So, the amount will be first debited. How purchase of foreign stock by Indian resident, that will be debited with $400. Since that has been debited, and in return we are getting the stock, and that has a minimum value of 400. So, that will be entered as a in the credit side as well. Okay. So, that is the reason why the balance of payment is in balance. Similarly, another transaction, that is $300 India's treasury bills purchased by foreign investor from his India's bank account. Any foreigner has a Indian bank account. From the bank account itself, the foreigner purchase India's treasury bill, that is government bonds and treasury bill, okay, which are defined to be the safest investment. Okay. So, in that case, purchase of India treasury bills by foreigner, since purchase is there and that too from Indian account. So, the money is due to come to Indian balance of payment structure, that will be entered as $300 as positive. And since that stocks has been purchased and India has the contract to give it back in terms of 300 shares with the equivalent value, then that will be entered as 300 as negative. Now, after defining some of the examples of balance of payment, we have to now discuss current account, financial account, and the balance account. So, first head is called current account. Current account basically defines as all sales and purchases currently produce goods and services or investment incomes and unilateral transfers, providing link between international transaction and national income. So, these heads are part of the current account entries. Current account surplus stimulates domestic production and income. Current account deficit dampens domestic production and income accordingly. Coming to the capital account side, it includes debit, forgiveness, goods, and financial assets that migrants take with them as they leave or enter the country. So, it is generally related to the debt and financial transaction. The country's deficit in the current and capital accounts in 2007 are finance covered by an equal or net inflow of capital abroad. The third aspect is called the financial account. Financial account shows the change in India's owned assets abroad and foreign owned assets in India. Okay. So, so India covers its current and capital account deficits with an equal net financial account surplus. If the net private capital flows do not cover the current and capital accounts deficit, the nation has a deficit in its balance of payment equal to the difference which needs to be covered by net credit balance on official reserves transaction. So, there is a official reserves transaction, we are going to show it in the data how these gets adjusted when there is a net deficit in the balance of payment. So, even in one head it might be negative or surplus, but in another head it will be different. So, official settlement balance, like the balance on official reserves transaction is also called balance of payment. Official reserve account, as we just cited, the account in which official reserve transactions are entered. So, this is calculated in this manner: current account balance plus capital account balance plus financial account balance or the net financial account balance, because we just subtract it from the official reserve transaction, but including net balance of financial derivatives that will be including, plus some statistical discrepancy is defined as balance of payment. Okay. Now, deficit in the balance of payment is basically refers to negative sum of account balances covered by an equal amount of official reserves transaction, as we already cited. Now, coming to the surplus, similarly settled by an increase in nation's international reserves. So, whenever there is a surplus, we will increase international reserves and reduction in foreign official holdings of nation's assets. Now, this is the diagram which refer to this is the design, the art refers to balance of payment. Usually it is not balanced because of trade deficit, financial outflows or debt repayments. Whereas in the surplus side we might have foreign investment, ICT receipts, tourist earnings and remittances, but if that is not exceeding, then there will be deficit. Now, there are some updates in the balance of payment structure. We will just count down some few of it, and in the next class we have the title called trends in balance of payment, and we will discuss in detail. Now, just to count down regarding current account deficit, which refers to goods and services, has been narrowed down to 0.9% of GDP in 2019 from the 2.1% in 2018-19. on the back of the trade deficit, which shrank to $157 billion in 2019-20 from 180 US billion dollar in 2018-19. Similarly, net invisible receipts were higher in 1920. Invisible, basically the receipt related to services are very much higher. Net FDI inflows also increases. Okay. Portfolio investment also increased. We will discuss all those things in detail. Similarly, foreign exchange reserves in nominal terms also increased to certain extent, and these are given here. Now, for your reference, I just wanted to mention that you please go through the RBI website, and from the RBI you can get the latest, very latest, even till the first quarter of 2021 balance of payment is mentioned. So, this is mentioned in quarter wise, July to September, and in a comparison it is presented 2019 and 2018. Then these are provisional estimates of 2019-20 18-19. Now, coming to the different heads of balance of payment, we have already mentioned this is current account. Now, this is capital account. Now, there are broadly these two which included capital account in the present calculation of RBI, included financial account, which are already shown. Now, capital account includes goods and services and primary income and secondary income. So good, it also included one of the important aspects may be asked in the question called does services include in the current account. Now, capital account includes FDI, portfolio investment, etc. Last section is called errors and omissions. We will show all those details in the next class, and next class actually covers each nitty-gritties of the trends, because the title of the next class is on trends of balance of payment. So, when deficits and are there or surpluses are there, what type of measures you usually take? To reduce deficits, we usually take, even these slides we are covering the next lecture. I am just taking a overview of it. So, we will promote the growth of import substituting industry, so that the import is going to be lesser steadily. Similarly, import restrictions by different strategies we already explained, extending assistance for export promotion, then providing incentive for increasing foreign exchange earnings on account of invisibles. Then especially from 1991, India has put comprehensive strategy like fiscal and monetary discipline, controlling aggregate demand, exchange rate and foreign trade policy reforms, structural reforms. We will discuss one by one in the next class. Delicensing, competition FDI and incentivizing FDI and portfolio investment, financial sector reforms, mobilization of exceptional financing. So, these are all aspects to be again discussed in the next class. So, with this I think I should close here, and I look forward your participation in the next class. Thank you.